Hey there, I'm Roger Herring. I'm the CEO and founder of Investors Accounting LLC. And guys, I am the Investors Accountant. Welcome to our seminar, Ultimate Wealth Strategies, where we teach you how to eliminate taxes, how to protect your assets, and how to take that money that you save and keep out of Uncle Sam's coffers and multiply it. And then we show you how to operate in a tax-free world. I love tax-free. So I hope you're ready to really get involved. This was taped on November 2nd. We had a sold-out full house. I'm looking forward to hearing your comments and your feedback on today. So let's just dive in right now. Here we go.
The Entrepreneur's Guide to Asset Protection and Tax Elimination. Now, why do I say entrepreneur when I primarily work with real estate? Yes, we've got real estate specific strategies, what I call big stick strategies, but we've also got strategies that will work for any kind of small business that we're going to be talking about today. Now, we got a great big crowd here today. This is the first sellout that we've had since COVID. That is awesome. All right, thank y'all for coming today. And I just realized something a few minutes ago. There are long-term clients in the room. There are people that I haven't met yet. There are folks that have just come on board. We've got a mix. But there's one person here today I want to recognize. I started this business downstairs with the Chamber of Commerce at their networking. And I met a lady named Courtney Field. Courtney, stand up. 2024 will be her 20th tax season with me. Thank you, Courtney. Are y'all ready to have some fun? You know, how the heck can you make taxes fun? I got a friend that says I make taxes sexy. You know what's sexy about it? Beating Aunt Iris. Who is Aunt Iris? That's Uncle Sam's evil wife. I love to beat up on Aunt Iris. So here we go. I am Roger Herring, and I am the Investor's Accountant. All right? I am an MSCTA, Main Street Certified Tax Advisor. What the heck is that? That's a tax strategy certification. That comes from, if you've ever heard of Mark Kohler, you see him online. He is a big-time CPA, tax attorney, and mentor to many accountants across the country. That's from his organization. I am a tax strategist. Now, what the heck is a tax strategist? I manipulate the tax code. Now, manipulate, that word gets a bad connotation, but look at the definition. I handle or control as in a tool or a mechanism in a skilled manner. That's all manipulating is. And it's manipulating the code, what's already written into the code, to make it work for you. That's all I do. So, a little bit about me. Tanks are awesome. I am ex-military. I went to the Citadel, the Military College of South Carolina, also known as Maximum Security College. The only school I know where the barbed wire faces in, not out. Okay? After that, I took a commission as an armor officer in the U.S. Army Reserve. Went to Fort Knox and got to learn how to play with M1 Abrams tanks. Lots of fun. How did I get into this job? This profession? Well, I've been an accountant since day one. Steve Harvey says, jump. Roger got pushed. Okay, you know what happens when you get bought? I was a division controller of a startup that we had taken from 0 to 50 million in 3 years. We got bought. And you know what happens to the management team when you get bought? They say, bye-bye, yeah, right there, out the door, see you bye. That's what happened to me. So I hung a shingle in pure self-defense. And that was a long time ago. So, why should you listen to me? I tell people all the time, be careful who you take advice from. I mean, a naked man offers you clothes. Obviously, he doesn't value the clothes very much because he's walking around naked. Let me tell you about myself. Let me brag on myself a little bit. I am a master of my profession. No, that don't mean I know everything, okay? That means I know how to apply the tools of my profession to work for my clients, okay? I learn constantly. You know what? My mentor knows tons more than I do, but I've corrected my mentor, and he's corrected me. And the other mentees in the organization, we've corrected each other all the time. If we don't know the answer, we know how to find the answer, and we know how to apply it for our clients. We constantly learn. You ought to see my reading shelf. It's crazy how many books I've got stacked up right now, okay? I've been doing this for over 30 years as an accountant. 22 years in full-time practice, okay? 22, that's a long time. That's a long time. Now, I don't just teach these strategies. I personally use the strategies that I'm going to teach you today. I know they work. Guess what? I don't have any reductive debt. What's reductive debt? That's bad debt. That's what Kiyosaki calls bad debt, debt that takes money out of your pocket. Do I have a car loan? Yes, it's a cash flow matter. I could pay it off in a heartbeat with my reserves if I wanted to. All right, but I'm not carrying the debt. I am an accredited investor. I can invest in things that most people cannot. So I know what I'm talking about when I'm speaking to you on these things. Okay? Where you are, I have been. Some of you actually have been with me long enough that you were in this building. This was my first investment. Not the entire building, just the second floor. We took down the second floor and created a 70-unit executive office suites. Now, I don't recommend this to be your first investment because guess what? 70-unit commercial, fresh out of the gate, that's tough. That's really tough. But I've been there. A little bit about our practice. I started this little side hustle back in 1999. What did I start the side hustle for? For a write-off, to be dead honest. It was a little consulting gig that I did. All right, but March of 22, I went full-time. Why? Because I got pushed. Full-time. As of 2016, we're 100% real estate. Now, you see that little star up there? There's a reason for that. We do have a small subset of clients that are considered high income, high net worth. A lot of these are financial planners. Some of these are former real estate investors that are ready to retire. And they're getting out of the active investment business and they say, Roger, we've been with you so long, please don't make us go away. I didn't. I'm a nice guy. The clients that we have, me, myself, and my computer getting ready to get in here so I can fire my boss one day, all the way up to almost 500 doors. Wendy just finished a return that took her 8 hours to do because of all the intricacies, however you say that word. It was tough, wasn't it, Wendy? Yeah, exactly. All righty. So, what are you going to see today? Some of the slides, those of you who have been here before, you're going to recognize them. Because, you know what? Good stuff doesn't change. Some of the slides are old slides that have been updated because we have new laws or we have new applications. Okay? And you know what? You're going to see Dracula rising from his coffin on some stuff. Because there's some old tax stuff, especially up in D.C., that's rising from the grave, and it's not pretty. We're going to talk about it today. All right? So, what's today about? The first portion of today is going to be about asset protection. Now, what the heck does an accountant know about asset protection? I'm not an attorney, but guess what? You know what one of the first things most of my clients want to talk about? Asset protection. They want to know about LLCs. They want to know about trusts. And over 22 years, I've learned a heck of a lot about this stuff. All right? Second thing, tax strategies. We got them for real estate. We got them for small business owners. More importantly, we've got them for the real estate pro, and we've got them for the non-real estate pro. Surprise, surprise. And then, something that is near and dear to my heart, operating in a tax-free environment. Why tax-free? Because I don't want Aunt Iris to ever get a hold of my money. I don't want Aunt Iris to ever get a hold of your money. So we're going to talk about Roth. We're going to talk about the CLLC. And I'm going to teach you techniques to get money out of the taxable world and the tax-deferred world over where? To the tax-free world where we never have to pay a dime. Cool? Now, some of these strategies that you're going to hear today, guess what? They've been around for a long time. Some of them are brand new. In fact, there's one I created not 30 days ago. Nobody else has ever published this one. And I have checked it and vouched it, and you're going to get to hear it for the first time today. All right? Here we go. Housekeeping. Education only, gang. Don't do anything I say, please. Facts and circumstances dictate everything. Even if you're my client, you had better talk to me before you start implementing stuff. All right? We're going to spend about 4 hours, give or take. It depends on how many questions that we have. Okay? I'm going to give facts and I'm going to tell stories. Why do I tell stories? People learn differently. Some people, I can go boom, boom, boom. Here it is. Here's my bullet points. And some people want to hear once upon a time, ... and then we started drinking, ... You know how it goes. All right? Here's why you don't do anything I say. Once upon a time, I had a client. And he got real scared. It turns out he'd been renting properties and just decided to stop making the mortgage payments. And he'd been doing this for about 1.5 years. I didn't know this till after the fact. And he says, I'm going to an asset protection seminar. I said, great. Don't do anything until we talk about what you learn. Didn't see him for 6 months. He comes back in. Well, we did the asset protection seminar and we've done this, and this. I said, oh, really? Congratulations, sir. You just cost yourself an additional $50,000 this year because you're right. This is an airtight asset structure. It is the absolute worst tax structure you could have had. 50 grand. That's a heck of a lesson to learn, guys. Now, what does Roger do now that Roger doesn't do taxes? He just sits back and eats bonbons, right? I am busier now than I have ever been. What Roger is concentrating on is strategy, tax strategy, helping our clients beat the IRS at their own game, manipulating the tax code to make it work for you. That's what Roger does, and you're going to get a good sense of what I do today. All right? Very important. Can we agree for the next 4 to 5 hours that all politicians are equally worthless? Yes. Okay? Guys, I got clients on the far left. I got clients on the far right. I got clients in the middle. Every single one of them pay me a lot of money to make sure that they don't have to give their money to Uncle Sam. The ones on the left actually are more vocal about it than ones on the right, believe it or not. I can't believe I have to pay this. Yeah? Okay, that's the way it works. All politicians are equally worthless. Now, we especially got to keep this in mind today because honestly, the blue approach to taxation, the red approach to taxation are 180 degrees opposite each other. And you cannot discuss taxes without there being some kind of political overtones in there, okay? My politics are simple. I hate politics, okay? I believe in low taxes. Here we go. All right, we aspire to create wealth for every one of our strategic partners. Who are our partners? You guys. How the heck does an accountant create wealth? Well, first off, it's what Ben said, Ben Franklin. You know what he said? Penny saved is a penny earned. That penny saved can be invested. That penny saved can be multiplied. That's my contribution, is to help you save the penny and keep it away from Aunt Iris. If you do this wrong, oh, look at that number, 45%. And in some cases, 50%. Ouch. I've got the knowledge, the tools, and we know how to use them. All you got to do is play the game. There are 3 reasons, and only 3 reasons, that you pay tax, folks. What's number 1? You made money. That's it. You made money. You know what number 2 is? You do something dumb. Now take a wild guess at what number 3 is. You did both. And unfortunately, people do both all the time because they're ignorant. Now, that doesn't mean they're dumb or being dumb. Ignorant simply means they don't know. They don't know what they're doing. They try to do things themselves and they make huge, huge mistakes. So, what is dumb? Ignoring proper business structure. Your business structure has more to do with how much you pay in tax than anything else. Shoddy records and bookkeeping. Guys, a bad tax return can be amended. Bad books will put you out of business. Let me say that again. Bad books will put you out of business. No books will quickly put you out of business. Okay? Ignoring tax planning. Ignoring what doesn't suit you. Oh, I don't want to do that. I've always done it this way. Yeah, but the law changed. Well, I'm still going to do it this way. I warned you. Failure to understand the consequences of your tax strategy. There was a fella at one of these seminars in here. Hadn't heard from him since. He was a local guru, and he was teaching a strategy to owner finance a flip property. Well, you can owner finance anything you want. What you can't do is use the installment sale treatment for tax purposes. So said flip, and that's what it was a flip. The entire profit as ordinary income is taxed in the year of the sale, whether you've got the money or not. That's a great way to destroy your business. Not acting timely. There are time limits. And one of my favorites, this is the new one, the short-term view. Guys, you can't sacrifice the long term for the short term. Because if you do something for the short term, that may totally mess us up for the following years. Okay? We look at the short term, but our vision and our focus should be the long term. Now, question, how do you pay the least amount of tax? Come on, y'all know this. Don't make any money, thank you, Gordon. Guess what? In real estate, there are ways to make money without making money. And we're going to talk about that today. All right, I want you to rejoice that you pay more in taxes than average Joe makes all year long. Now, I have to remind myself every October when I have to write that dad burn check. All right, I remind myself, but we're blessed because we're making more money or paying more in taxes than they make. Here we go. The M4 wealth principle. Guys, you've seen this before. These are 4 strategies. They're independent, interdependent, and simultaneous if you want it to work for you. Make it. Very simple. You know how to make money. That's your W-2. That's your side hustle. That's your ordinary income business. Multiply it. That's your investments. That's your rental properties. Manage it. Guys, if you can't manage $100, you can't manage 1,000. If you can't manage 1,000, you can't manage 100,000. If you can't manage 100,000, there ain't no way this side of heaven you can manage 1,000,000. Managing money is one of the absolute keys because it's not about how much you make, it's really about how much you keep. That's the bottom line. And manipulate it. Now, here's a surprise. What if I told you you're not starting here? You actually have to start here. Because before you have made a dime, you got to set up your business structure. If you're in the wrong business structure, your manipulation doesn't work. Before you make a dime, you got to manage the money you get from the bank to do the rehab on the property. You can't go out and buy the new Cadillac. All right? Once you make the money, you get to put it in your pocket, right? Wrong. You got to reinvest it. Paying yourself first does not mean that you get a paycheck. That means you're putting more money aside to go out and do what? Multiply it. What does it mean to multiply? Well, certain investments have things called multipliers. And we're going to talk a little bit about that later because you know what? One of the best multipliers ever known to man, rental property. Because that idea alone, there are about 5 different multipliers inside of a rental property. Okay? Now, guys, you need some protection. Who do you need protection from? Those people that want to sue you and the people that want to tax you. So here we go. Let's talk about some asset protection. Okay? First and foremost, LLC 101. This is in every single one of my seminars because this is the number one thing that most small business owners screw up from the get-go. Sometimes if it's the first year and they mess up, I can fix it. If it's beyond the first year, we may have to start over on some stuff because it can be a royal mess and it can cost you quite a significant amount of money. LLC 101. I always want to use an LLC. Why? It is the most flexible for taxes. I can have this taxed as a sole proprietor, a partnership, a C Corp, or an S Corp. It depends on what paperwork I file or what paperwork I fail to file. In some states, it'll have better protection than a straight corporation. Here in Georgia, the Georgia Limited Liability Company Act says that commingling on its own will not necessarily void the veil of an LLC. That's straight out of the code. Guess what? What's the number one way most attorneys penetrate a corporate veil? Commingling. What is commingling? Commingling means you pay personal expenses out of your LLC or your corporation. Okay? Now, even though the state of Georgia says an LLC that wouldn't void it, I don't recommend you do it. You need to discipline yourselves and operate with separate bank accounts. Now, do you need one bank account per property? That's overkill. That's crazy. We don't want to do that. We want to exercise common sense though. Okay? Now, once we have an LLC, we're going to make a tax selection. This is going to define which section of the Internal Revenue Code you're taxed under. What does that mean? That's going to determine what deductions you are allowed. It's also going to determine your tax rates. It's going to tell me whether or not you can have a salary or whether or not you're stuck paying self-employment tax. Or maybe if you structure wrong, you're having to pay self-employment tax when you shouldn't have had to pay that at all. Yeah, this is totally going to vary depending on your business. Okay? We don't treat landlords the same way that we treat flippers. Flippers might be treated the same way you treat a financial planner. but not for a property manager. There's a lot of rules here. We're also going to vary depending on your personal situation. Are you married? Are you single? Are you going to get divorced? Do you have kids? Do you not have kids? Do you need more than one LLC to execute your strategy? Sometimes the answer is yes. Okay? Next question. Where do I set up? Do I go to Wyoming? Do I go to Nevada? Do I set up here in Georgia? Do I go to Utah? How about Delaware? You know what? I really don't care. I don't care because there are no federal tax advantages to where you set up. You see, if you are in Georgia, you work in Georgia, you're going to get taxed in Georgia. Bottom line. If you live in Georgia but work in Florida, you're still going to get taxed in Georgia. Okay? Before you start writing huge, big honking checks to set up a Nevada corporation or a Wyoming corporation, exercise some common sense. Think about this. How much cash flow am I protecting? Well, I don't have any yet. What are the value of the assets I'm protecting? Well, I haven't bought any. I'm a startup. How much is this going to cost me to set up this huge honking structure out in Nevada versus to set up a couple of LLCs here in Georgia? What are the recurring costs? Is it $50 like here in Georgia, or is it $500 like in other states? Something to think about. Could you form locally and buy insurance and accomplish the exact same goals? Something to think about. Now, guys, I'm not telling you not to use a foreign LLC. I use them all the time. But the right tool for the right job. That's the key. Insurance and your LLC. Guys, you know what your first line of defense is? Being a good business person. Always, always, always. The second is insurance at the property or the business level. The third is that LLC veil. And then every single one of you ought to be carrying an umbrella policy worth about $2 million minimum. Guess what, guys? That's not expensive. I don't sell insurance. I don't form LLCs, but you need them. Okay? Now, make sure that policy covers properties held in LLCs, because not all policies are created equal. And please, for the love of creation, read the damn policy. I have a friend, he owned a franchise. It was a Mr. Handyman franchise. It was in Lawrenceville. Courtney knows him. Remember Daryl? Yeah. Daryl had a real good first quarter. And Daryl bought brand new equipment. Daryl left, 5 o'clock, and here come the thieves. They took the pickup truck, rammed through the front window of his business, and took every single piece of new equipment. Took them maybe 10 minutes. Insurance company refused to pay. Why? He had a discount for an alarm system, and he forgot to set the alarm when he left that day. Therefore, based on the rule of contributory negligence, they didn't have to pay him a dime. And he lost thousands. Ouch. Read the policy. Now, how many LLCs do I actually need? Let's go to the whiteboard. Everybody got the passwords if you need them? Normally I've got a big old piece of butcher paper up here, but I decided that I would invest in a whiteboard as much as I teach now. So, how many LLCs do I need? Well, we're going to draw a little diagram here, okay? This is called a trifecta. The trifecta kind of outlines your business life. Over here is your ordinary income. Over here are your assets. Down here is your 1040. Okay, how many do we need? Well, look at my rules. Type of income. If you have ordinary income, you have an entity over here. If you have passive income, you have an entity over here. So if you flip and own rentals, you need at least 2 LLCs. Okay? How much equity do I have in my rental properties? How much risk do I have? A property that I can eyeball every other day because it's around the corner has a lot less risk than a property down at Grant Park where my pipes are stolen every other day. True? Yeah. Or like one of my friends and clients the property I can eyeball has a lot less risk than the frat house at University of Alabama. Yeah. Okay. Next thing, eggs in the basket. What does that mean? If I've only got 2 eggs and they're in the same basket and I trip, I'm going to break both, right? So if I got 2 rental properties, I'll probably do this. I'll split them, and now I'll have 3 LLCs. My management LLC, where my bank account is right here. Here are my properties down below. My eggs are not in the same basket. When I add a 3rd property, I'll probably do this. Add a 3rd LLC. Now, I got 3 eggs out there. I'm going to start following the equity and the risk rules. Let's say that I have $100,000 in equity in each of these already. My idea is to even up the amount of equity across the board and to split the risk. Now, let's say that I did buy a new frat house. You know what? Mr. Frat House is going over here all by itself, regardless of how much equity it has, because of the risk. Okay? Let's say that I buy another single family, and I'm not going to have but maybe $50,000 worth of equity. Well, I'm going to pick a property, and I'm going to put it in. Let's say we'll put it in here. My next property I buy, $75,000, no problem. I can put it in another one, and what I'm doing is I'm stacking into each LLC, watching the equity and evening out the equity and the risk. Now, what happens if I inherit my mother's house and turn it into a rental? Especially if I've got 100% equity. You know what I'm going to do? It goes by itself. Why? You don't put unleveraged property in with leveraged property, ever. I buy an Airbnb that has massive cash flow. I'm not going to put it in with my single family rentals. The cash flow is different. I'm always going to put a multifamily 5 doors or more by itself. Always. And I might consider that for high-performing quads and duplexes. Okay? So, the number of LLCs you have depends on you. There is no cookie-cutter answer. This is exercise common sense. Now, Roger, I've heard that I should put 1 property per LLC. Wrong. In the beginning, yes, but that's overkill. But that's also totally up to you. If that's what makes you comfortable and you're willing to pay for it, do it. That's the way it works. But you don't have to. Okay? A one-to-one relationship is not necessary. Well, Roger, I've got more than 1 ordinary income business. Well, you know what? Here's the LLC, and I'll go ahead and jump ahead. If it's ordinary income, it's also going to have an S election. And I've got multiple businesses. You know what I'm going to do? I only want 1 S Corp, guys. 1. Down below, I might have different businesses in different LLCs. What you don't know is Investors Accounting, LLC, is a wholly owned subsidiary of the Investors Accountant, LLC, a Georgia S Corporation. What you also don't know is underneath this is R.T. Herring and Associates, which is also a wholly owned single member LLC by who? The Investor's Accountant, LLC. There are multiple businesses, but one S Corp, because that S Corp is my tax planning entity. And you should have no partners in your S Corp other than your spouse, and in some cases, a child. Why? Because it's your number one tax planning entity. You keep it for yourself. Whew! Let me put that back. There we go. Y'all ever heard of a COPE? This is one of the reasons that we might use for an LLC. A COPE is a charging order protective entity. You know, LLCs, I'll just draw this. LLCs are designed to protect us if we're sued here. Right? What happens if you're sued here? Personally, can they get to your LLC? Yes, they can. Because if you've got no insurance and your only assets are in the LLC, Georgia is known as a foreclosure state. That means whether it is a single member or a multi-member, they can get a court order to seize your membership and liquidate assets. They can foreclose your interest. A COPE, however, is formed in a state where we have a charging order. Now, a Georgia LP is allowed a charging order, okay? But most people don't operate in LPs because then you have to have a C Corp member and it can get a little messy. So here's the deal. A COPE is set up in a place like Wyoming. Whoop. Hit way too many buttons there. Jumped into the trust section. Let's back up. One more, come on. There we go. All right. What is a charging order? Charging order is an order from a court that is obtained by a creditor that allows them access only to your distributions coming out of the LLC. They cannot foreclose your interest. Okay, so there is more protection. Now, there are only about 3 states in the entire country that provide COPE protection to a single member LLC. Wyoming and Nevada are the 2 best known. I believe the other one's Ohio. Okay? But we use a COPE to be this top level when we've got significant assets. Now, you only got 1 or 2 rental properties. You don't need to even worry about this. All right? I wouldn't start worrying about this till you have between at least $750,000 worth of equity. Okay? For some people, it's less. For some people, it's more. Okay? That's the COPE. Now, real estate investors have a very bad habit. You like to do things yourselves. Stop. Stop this instant. Because the real estate investor that I met with this week that's been doing it himself, once I redo this tax return or once Wendy amends the tax return, they're going to have to pay about $45,000 because they did it wrong. They made some assumptions and those assumptions were not correct. So let me refer you. What about a trust? Trust cures everything, right? Maybe. Here we go. There's 2 kinds of trust. And the trust, if you wanted to know about the trifecta here, the trust is down here. I hit that button again, didn't I? All right. Trust is down there. Here we go. First off, a revocable living trust. Everybody and their brother, in my opinion, should at least have a revocable living trust. It is disregarded for tax purposes, meaning the IRS doesn't know it's there. Okay, they don't care. There's no gift tax when you move from your personal name over to the trust. When you pass away, your children get this wonderful thing called a stepped-up basis. Let me explain that because this is an important concept and you're going to hear it again. My mother passed away a year ago this month. I inherited a condo that she's lived in for nearly 20 years. She bought that condo for about $75,000. We sold it for $400,000. Okay? It was actually worth $425,000 the day she passed. Under the stepped-up basis rule, the day that she passes away, I inherit the property. My basis is not what she paid for it way back when. My basis is the value date of death. So I flipped that condo because I couldn't rent in that neighborhood. We flipped it, and I put the money in my pocket and have to pay no tax because I have no gain. I cannot take the loss because it was worth $425,000 and I sold it for $400,000, but I'm not allowed the loss. Do I really care? No, I don't. Guess what? Stepped up basis is one of the things that's in the crosshairs of DC. We'll come back to it. There is also an irrevocable trust. Now, here's the thing. There's no asset protection in the revocable. There is in the irrevocable. But when you transfer assets from your personal name to the irrevocable trust, there is gift tax concerns that we have to look at. Oh, and once it's in there, if it makes money, you have to pay tax at the trust rates. Who knows what the top tax rate is right now? 48%. Actually, no, just the income tax rate, not the combined. 37. 37. Guess where the 37% bracket starts for most married people? Just under $700,000. You know where it starts for a trust? $12,000. Ouch! Don't let anybody tell you if you put it in an irrevocable, you'll never have to pay tax again. Oh, there's no stepped up basis because you don't own it. The trust owns it. Okay? An example would be a spendthrift trust. So, if you're at a RIA meeting and somebody is peddling my new uni trust, and for the low, low price of $27,999, you'll never have to pay income taxes again, they are a liar, Charlie Brown. Now, wouldn't it be nice if there was a hybrid? Whew. How about a trust that has the characteristics of both the irrevocable and the revocable? Estate planners have been using these for years, guys. It's a grantor trust, but it's irrevocable. It'll give you the asset protection you need, but the pass-through tax treatment. You'll get your step up in basis, and there's no gift tax. Would y'all like that? Nevada, raise your hand. Allow me to introduce, no, wrong Nevada. Right there. Nevada Tuggle, attorney at law, friend of mine. You know what he is? An estate planner. He does these trusts. If you're interested, see him at the break. Okay? What about a land trust? Where does it fit in? You know, land trusts, they ain't all that. Okay? There are groups that will teach you, oh yeah, you put everything in the land trust for anonymity's sake. Well, guess what? If you bought it in your name, it's already in your name. Putting it in a land trust, they're still going to be able to locate it. Okay? It doesn't give you any asset protection because it's a revocable trust. Whoever tells you it's asset protection, they're not telling you the truth. What do we use a land trust for? Transfer of property. It's been used for years in a subject to transaction. And we're going to talk a little bit about subject to later. And some people, you know what? If you want to move a property from one LLC to another without upsetting title or anything, you can use a land trust. But you know what? You don't have to. Here we go. Guys, probate sucks. I have been through it twice in 12 months. Probate sucks. Use an RLT to avoid probate. Not a protection strategy, it's an organizer. Here's the problem. Most people that have a revocable living trust have never funded the revocable living trust. That doesn't mean put money in it. That means retitle your assets to the trust. If the assets aren't titled to the trust, guess what? You don't avoid probate. They're getting probated. Wills get probated. You know what your will really should say? I leave everything to my trust. Plain and simple, and then let the trust documents execute what your intent is. Okay? Oh, I want you to read this. Don't add kids to the title. Also, do not let parents do their own estate planning, and don't you do yours. Let me tell you what happens if you decide to, I want to avoid probate, so I am now 80 years old and I decide to put one of my sons onto the title of my home. Guess what? I just made a gift to that child. What's the gift? Fair market value? No, my basis. I have to report that on the gift tax and exempt it. But here's the problem. Now I die. My son inherits the house. My half of the house, I get a stepped up basis in. The part that I gifted to him, does he get a step up in basis? Absolutely not. So if I bought the house for $100K and it's worth $500K, his new basis is going to be $50, which is half of my original basis, plus $250. So if he sells the house, he has a capital gain. Ouch. Don't put kids on assets. Don't gift assets to children. Let them inherit. Okay? Next. There was one right back there first, and then we'll come up here to you, Ann.
I have a question about the LLC structure.
Uh-huh.
You were talking about the three ways to separate it as ordinary income, assets, and then the 1040. Mm-hmm. But if you have various LLCs, some that you own on your own, and then with partners, you keep those all separate. But with the partners, if you have multiple properties, do you need to sub it even further?
Okay, the question was, if you've got rental property, what if you have partnerships under there? And guess what? That's absolutely no problem. It's no problem whatsoever. The only thing is, let's just go to the board and draw it real quick. What you would have is the LLC. And what you might have is a master LLC, is what we call it, that belongs to you. And down below that master, there might be 3 or 4 different partnerships. And obviously, half of that or whatever your ownership percentage is flowing back. But yeah, the same general rules apply. Okay, the same rules apply. And what I tell people is, you know, if you're going to do business over and over again with the same guy, then definitely set up an LLC together. I don't ever recommend, in general, that you do what's called a joint venture, except in very specific circumstances. Okay, a joint venture is you go take down a rental property and you're taking half as your Schedule E property, they're taking the other half as their Schedule E. The problem is, Bum, 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 bum. So the problem with the joint venture is it's very easy to kind of get lost and one partner have to foot the bill. And guess what? You've got no asset protection unless you're owning your part with an LLC. Yeah.
But if the partnership has different types of assets, so the same partner, but you have like a portfolio of single-family homes, but then you also have like apartment complexes, you split those then into two.
You would split them up, and what you can have is one master LLC. The question was, what if the partnership has multiple classes of assets in it? So what you would do is have the partnership, and the partnership would have sub-LLCs. Here's my apartments, here's my multifamily, here's my single family, here's my commercial. You would just split it up just like you would if you had multiple houses. Okay?
But would the master then be an S corp, or you just leave it as an LLC?
You always, never, ever hold rental property of any type in an S corporation. We're going to talk about that. Okay? That causes problems. You have a question?
Yeah.
Go ahead, Jasmine.
Hi, Roger. So you were saying that we can have separate LLCs, but do business out of one bank account?
Yes.
And it doesn't matter, as long as the bank account has one of the entities as the name?
Here's what you want to do. The question was, can you have multiple entities in one bank account? The answer is yes, but the bank account should be here at the top level. You don't want to say have a bank account here and then you're paying for everybody else. Okay, that's messy. Bank account should be up here. Okay? Back there on the left. Well, actually, Ann, I said I would come to you next. I'm sorry.
It's just a simple question.
All right, go ahead.
So for the umbrella policy, I hear this all the time, but is it just any insurance company or is there a special insurance company?
You don't want to go to an insurance company that has restricted writability. In other words, if you went to State Farm or Allstate, they can only offer you State Farm or Allstate products. Go to an insurance broker that can do multiple lines and can work with multiple companies to get the correct policy you need. Because not everybody is going to do an umbrella policy specifically for rentals. Okay? Back to sir.
So with the LLC, are those regular LLCs or series LLCs, or does it make a difference?
There are no series LLCs in Georgia. Okay, series LLC, the closest state you're going to find one is Tennessee. So here in Georgia, we have to create our own series. Okay? Who was next? She already asked. Get Jacob right there, and then we'll come right up here.
So you said it was overkill if you have a separate LLC for every property.
Yes.
So is that regardless of whether there's debt on there or not? So if you have multiple properties with no debt, do you still think that's overkill?
Okay. The question was, is it overkill if you have multiple properties with no debt? Normally, if I have a property with no debt on it, I would put it by itself, but I would also question myself because I don't think you should have a rental property when you're not carrying a mortgage, because then you're using your money and not other people's money. You're losing one of the multipliers that we're going to talk about. We'll come back to it, okay? Yes, ma'am.
Regarding LLC and subsidiary, I just Googled it because I wasn't sure how to create a sub-LLC. Can you let me know if this is correct? So you just go through the same process as the LLC, but it says the parent company has to be the member of it. And then do I put my individual as another member, or just the parent company?
You're the parent company only. You become the manager.
Okay, and then that's it, right?
Correct. The question was, when setting up a multi-tier LLC, where an LLC owns another LLC, who's the member? The parent LLC is the member. You as the individual are the manager. All right. Did you know you got a business partner, gang? Yeah, you're good old Uncle Sam, holding out his hand, sending his wife, Aunt Iris, to collect your money. You know what? The IRS. If you add those two words together, they think your money is theirs. That's what the IRS thinks. I got news. It's not theirs, and we're going to do everything in our power to keep it out of their coffers. So, The good book says, give unto Caesar what is Caesar's. But you know what? Who defines what is Caesar's? Caesar does. That's the Internal Revenue Code, Title 26. If you wanted to read the entire Title 26, it would take more than 10 lifetimes. That's how complex and complicated it is. If you wanted to read the rest of the state codes and the local codes and everything that goes into it, it would take over 10,000 years for the average person. What I'm saying is, there is no living person on earth that knows the entire tax code. That's why I specialize in specific parts of the tax code. Now, my first mentor, Clyde the Glide, Clyde Hires, he was my professor for Accounting 1, Accounting 2, Corporate Tax, Partnership Tax, Estate and Trust Tax, Intermediate Tax, Individual Tax. Clyde was the man. But you know what made him special? He also practiced. So he wasn't your typical academic that tells you what to do and has never done it himself. Clyde was a great guy. When you know the rules, you can play the game. He always said that in class. Now, I add to it this. When you master the rules, you win the game. Every single time. The rules are there. And the things that I'm going to teach you today, guys, are not even gray area. All right? These are solid, established strategies. But people just don't do them. Some of them because they don't have time. Some of them because they don't know. Well, after today, you can't say you don't know. Here we go. When you're building a tax strategy, sometimes it's a big stick. You're going to take that huge driver out of your bag. Sometimes it's a little stick and it's a little bitty 9-iron that you're pulling out. Right tool for the right job. But you've got all the clubs in the bag and it's all working together to play the game. So, I'm the accountant. There's also this gentleman called an underwriter. And what my goal is and what his goal is are two totally different animals. So when you come to me, if you're going to be borrowing money and there's any doubt that you're going to have to go through extensive underwriting, you need to talk to me because my goal is to eliminate your income. And I'm going to use every tool in the bag to do it. Their job is to protect the bank. They want to see that you have income. And, you know, I get crazy requests from some underwriters. Once upon a time I got asked, said, the only way we're going to grant this loan to your client is if you sign a statement that says you will not pass the S-Corp loss through to their personal return. And my response was, you realize that's illegal, right? Well, that's what we're going to do, and my answer is no. Client fired me. I can't go against the law. Now, why the martial arts slide? Oh, back in the day, that was me. Yes, I really do have a black belt, and yes, I really did teach karate at one point in time. That was my hobby. Surprise! Things to know, guys, we're getting into taxes. Here we go. 2023. Essentially, the 2023 tax code is identical to 2022. You got a mileage rate of 65.5 cents per mile. Meals are down to 50%. They've been 100% since COVID. That changed this year. Bonus depreciation, 80%. We had 100% from 2018 through last year. This year we're down. Everybody got your photos? All right. Next year, 2024 is almost identical too. Mileage has not been determined. Meals are still 50%. Only entertainment allowed is meals. That's been the case since 2018. You can't take a client to play golf. You can't go to a ball game. Oh, and if you go play golf, but you don't write off the cost of the golf, but you write off the food in the clubhouse, that's not deductible either, guys. Sorry. Bonus depreciation is down to 60%. Why? We are in now what they call phase out. Bonus depreciation will be totally phased out by the end of 2026, unless something happens in DC. Now, what about NOLs? Well, Roger, I don't want to lose money. No. We create losses when we do things like cost segregations. All right? When we're creating losses, we're doing it on paper by depreciation or by a tactic such as how to pay your children, which is just reclassifying money you're going to spend anyway. But here's the deal. NOLs are now limited to 80% of your adjusted gross income. So if you have a $100,000 loss this year and a $100,000 income next year, you can only write off $80K. That's the way that works.